Happy Sunday, fellas. We don't typically record videos on Sunday, but this is going to be an atypical video. We're going to talk about our largest position in the fund. For those of you who don't know, I run an investment management company. However, I'm 23 years old. Most of my friends don't meet the legal requirements to be charged a performance fee. There are legal requirements for that based on net worth. So they often ask me, stock tips. What should I buy? I've got $1,000. What should I buy? And I typically give them a couple names, and like any sensible person, they also want an explanation for that. I'm gonna make this video for them, for those people that ask me for stock tips, and for anybody else that wants to get rich and then hopefully one day becomes rich enough that they can become a client and get the full service management, because believe me, it is worth it. And you can ask any of our existing clients, it is worth it. So here's a stock pick that I like. I'm going to explain it for you, the reasons why I like it, the reasons why it's the largest position in our fund. But ultimately, the full service is where you want to be, because disclosure might sell the stock at some point. Our portfolio has changed dramatically throughout time. We're always adjusting it. This is part of the reason why I'm not a huge fan of just giving advice. I want the active management side, because we move around, we pivot, we change our minds, we're fluid. And for that reason, I'm going to give you the overview today. But don't just take this video and, run with it. I think this is a very good stock. As I said, it's our largest position for a reason. But in general, to those people who ask me for advice, my advice can always change. We record videos on this channel every day. If you want the advice, watch the videos every day. Don't watch the video, stop watching for 3 months, and expect our thinking to be the same. It might be not. Anyways, that's enough random stuff. Let's get into the discussion about PBF. PBF is an oil refinery company that was founded in 2008 during the global financial crisis. There was a massive spike in oil, a massive pullback, and they were essentially tasked with the objective of going out and acquiring various refinery assets. It was a couple private equity guys. They went and decided to form this company, which is now one of the largest refineries in the world, but more importantly in the United States, up there with Valero, ExxonMobil's refinery division, et cetera, et cetera, et cetera. This company is no joke. However, in the COVID crash, the stock fell dramatically. They had a ton of debt, and a lot of people were thinking various oil companies weren't going to make it. And this was one of them. They had a lot of debt at the time. However, that fear around the debt, around them collapsing, is now working to our benefit, because in my opinion, the stock hasn't fully readjusted to the new paradigm in which it sits. If you go and listen to the last earnings call, you'll hear about how they spent a lot of money paying off debt. They spent, if I remember correctly, looking at the cash flow statement, $1.4 billion paying off debt. They, at their peak, had just over $4 billion worth of debt. So they have virtually extinguished almost all of the debt at this point. Now let's get into the numbers about the stock. Assets minus liabilities, 13.3 billion in assets and 9.09 billion in liabilities. Assets minus liabilities, 4.21 billion. Now, what do we do with this number? Well, we have to compare it to the market cap of 5.9 billion. So that's about $1.7 billion spread between the assets minus the liabilities and the market cap. However, I'm not going to put all my eggs in that assets minus liabilities bucket. Why would I not do that as an analyst analyzing a stock? Because I don't know if that asset value is correct. This company is incentivized to over-report the value of the assets, of course, because it should increase the stock value. They just got to change the number. And I'm not saying they're doing that. I'm not making any claim about that here. I'm just saying it can happen, and I'm sure it does happen. So I'm not putting all my eggs in that basket. However, we're just taking a skeptical, conservative approach here. I'm not trying to say anything bad about the company. I'm just, as an analyst, taking a skeptical, conservative approach. I hope that serves you, the viewer, well. because we're about to get into our next thing, and hopefully it will reiterate why the stock is our largest position. This company's cash flow exploded last year. And even in Q4, the projections, now we're gonna get Q4 earnings, but the projections are this company is still gonna make figures like this. So in Q3 2021, which is off the peak of oil, still higher prices than we are today, but if you've been watching the most recent videos and videos for the past couple months, you'll know we expect the price of oil to reverse. We're not gonna get all into that today, but just know that the strategic midterm reserve has come offline and China is reopening. The Fed mentioned a couple times this week. The ECB is mentioning that commodity prices, China reopening, might lead to commodity prices hiking. You look at oil, it looks like it might have bottomed. You look at copper, looks like it might have bottomed. The oil situation will definitely work in PBF's favor, although they don't sell oil. They sell refined products. So they just make a spread above whatever the price of oil is. So it's important, but it's not too important. Anyways, Q3 2021, roughly $1 billion in cash flow after taxes. That's in a single quarter. All the other quarters last year were very similar, 1 billion plus. The projections for Q4 of last year, which we'll get earnings at some point in the near future, over 900 million. Roughly $4 billion in earnings per year in the ideal environment. The market cap is 5.9 billion. You're getting almost a 1 price to earnings multiple, 1 PE. That is tremendous. Okay? That is tremendous. Apple, you got to wait 20 years plus. Microsoft, 20 years plus for them to earn the value of the company. PBF, 1 to 2 years. However, that's just cash flow. We go back to the assets liabilities. The assets minus liabilities is 80% of the market cap. So you're basically just getting the cash flow, if you wait 1 quarter, for free. That's how I'm viewing it. If you've got objections, let's get into it in the comments. I might have to amend the video, but based on my understanding on how to value a business, I think this is a tremendous buy. I think the amount of time you have to wait is very little. I think this stock is mispriced because it's had a ton of debt. It hasn't had very good environments for its business. It suffered in COVID. People thought it was going to go bankrupt. It still has a relatively low credit rating, although that credit rating is increasing. So there's a reason why the stock might have been feared in the past, and I think that it's benefiting us now as people looking to deploy cash somewhere that makes sense in this weird environment. I think this is a pretty good place to put it. So PBF is our largest position. We like the stock. And if it pulls back, we're going to add to it. We're not concerned about the short-term movements in the stock. I personally think it's a $100 plus stock based on the numbers I've told you here. And maybe the cash flow will even go up. So one final thing, because I know people are thinking, oh, it's an oil company, why should it have the same multiple as Apple? Let's address this concern. Excuse me, need water, don't have water on deck. Let's address this concern about oil companies, valuations, not being tech companies, them going away in a couple years. First of all, they're not going away in a couple years, but let's just grant that at some point, we're going to be using less oil, maybe. I mean, we're not, probably, because all plastic is used of oil. All roads are made from oil. Oil is like a tremendously important product. Airlines, it remains to be seen if we can do electric planes, probably. We can't do electric rockets, but we'll see what happens with the electric planes. Anyways, even if we had 100% adoption of electric vehicles for new car sales, it would take 20 years to replace all the cars here in the United States. Then you look at Africa and India, where it's a much lower electric vehicle adoption rate, yet a much higher rate of population growth and a much higher population overall. Okay, the oil picture is not going away tomorrow, okay? You can say, oh, we're going to stop using phones because Meta is going to we're all going to be using Meta. Should we stop selling Apple? No, because they produce tremendous cash flow, and that remains to be seen, that concern. It's just a hypothetical concern. Additionally, we got plenty of points to attack this. We're starting from ones that you might have heard most likely, you might have heard before, to the ones you probably haven't heard so much of. Next point. PBF does a lot of diesel work, a lot of diesel refining, creating diesel products. Diesel gets better mileage for cars, and cars, particularly trucks, most nowadays it's pretty much trucks that use diesel. Trucks that use diesel, cars that use diesel are more reliable. So the average length of a car on the road is 20 years. I don't know what the average length of a diesel car is, but it's longer. I can tell you it's longer. And trucks that can go 500,000 miles without a single piece of major maintenance, they're going to be on the road for a long time. I get it. The Tesla Semi is coming to market now, but you can do the math. There's going to be diesel demand. And last week, the EIA, the OPEC increased their expectations for oil consumption. So you can, in my opinion, put those fears aside and take advantage of a stock trading at a 1 to 2 PE that just announced a buyback of 10% of the shares. It's a tremendously large buyback. They paid off the debt. Now they're getting into capital returns. You're just going to get cash flow. This is a stock that you don't sell. This is a multi-year hold, okay? Oil stock, multi-year hold. You want to be like those rich people in Texas? This is how they did it. You got an opportunity here. You can take it or you can leave it. Up to you. I'm just giving you what I'm thinking, and I may or may not be right. Finally, with regards to the oil companies going away, this fear. One of the oldest public companies, you know what it is? It's not Microsoft. It's not Apple. It's ExxonMobil. You know what ExxonMobil started as? Not an oil company. When they started, nobody used oil. Cars weren't around. They just refined other products, plastics, chemicals, other things. They just did the work for other things. Companies can adapt and change with the times. Exxon, which is just a very pure business, very first order of the economy business, focused on resource extraction and refinement, that's something that's always going to be around. I would say the likelihood of ExxonMobil being around in 100 years is higher than the likelihood of Microsoft or Apple or Netflix being around in 100 years. Every business has a lifespan. They exist, they go away. The world has changed. The same thing with every country pretty much. It's hard to imagine the United States could go away, but it was hard to imagine the British Empire would collapse. It was hard to imagine the Dutch East India Trading Company, the company that invented the stock market, would go away. But it's not around. There is no Dutch East India Trading Company. So don't put your weight in that, okay? Nobody is really thinking about 20 years. I get it. Maybe Warren Buffett is, but that's not true. The person buying Apple stock, they say that. They say, I'm going to hold for 5 years. They might hold for 5 years, but when that stock's down, they're not having a good time, okay? So I'm not saying be a short-term trader, look for the week-to-week, day-to-day bet, but this idea that you need to be concerned about oil companies going away, I think is false, and it's just, in my opinion, an immature market and economic analyst assumption that you would make a decision like that, because every company is going to go away. The Dutch East India Company went away, and they invented the stock market. So you make your calculation based on the earnings multiple, based on the cash you're going to get out of the company, based on assets minus liabilities. And in my opinion, all those forces are lining up very well for PBF, and that's why it's our largest position. So that's today's video, and until next time, peace out.